Good morning, everyone, and welcome to Carr, Riggs, and Ingram's webinar, Governmental Accounting and Auditing Omnibus. My name is Dean Mead. I am a CRI partner and Government and Public Sector Subline Leader, and I will be serving as your moderator. Let's get some of the fine print regarding continuing professional education, or CPE, out of the way. CPE is offered for this webinar at 2 credits for the accounting governmental technical field of study. CPE hours are calculated at 1 credit per 50 minutes in attendance, and partial CPA credits will be offered in half-hour increments after the first 50 minutes of attendance. This webinar does not offer NASBA CPE. It offers state-level CPE credits subject to the approval of respective state boards of accountancy. Please be sure that you have logged in with your unique link and that you stay logged in for the entire webinar to ensure that you receive your full CPE credit. Attendees must answer a minimum of 3 poll questions per hour to receive CPE credit and log attendance for a minimum of 100 minutes. So there will be 8 questions total, 4 per hour. You only need to answer to receive full credit. Your answers do not need to be correct. And certificates for the CPE will be distributed via email within the next 7 days and will be delivered from the email address that you see on the screen here. So if you don't see the certificate in that time, please be sure to check your junk folder. Lastly, there is a PDF handout of the presentation slides that is accessible for download through the Zoom chat in this platform, and will be posted as well following the presentation to cricpa.com. We have 4 terrific presenters today. All of them are CRI partners and government and public sector subline leaders for CRI. All of them are also very knowledgeable and experienced in governmental accounting and auditing. We are very fortunate today to be hearing from Becky Hammond, who is in CRI's New Orleans office, Matt Montemayor from our Harlingen, Texas office, April Shuping from CRI's Gainesville, Florida office, and Pat Smith from our Bradenton, Florida office. And me, I've already presented. So I am the least interesting of the 5 presenters today. Today's webinar will begin with an overview of the upcoming effective dates for GASB statements, and then cover 4 topics. GASB's most recent statement, number 102, on certain risk disclosures, an update on the most recent developments related to single audit, the Financial Data Transparency Act, or FDTA, and its implications for governments, and lastly, a rapid review of what the GASB in its 40th year has done so far and what is coming up for 2024 regarding final statements and proposals for public comment. So starting off with an overview of GASB effective dates for statements that governments are going to be implementing over the next several years. This slide, which is based on a terrific slide that the GASB uses in its presentations, is up to date through Statement 102, which GASB approved in December of 2023. And you can see that governments that have concluded or are wrapping up their 2023 audits have gotten over a significant hump and are looking at a lighter implementation load for the next few years. For these June through November fiscal year ends, they have Statement 100 on accounting changes and error corrections coming up for fiscal year 2024, Statement 101 on compensated absences, and Statement 102 in 2025. The primary difference for December 31st fiscal year ends is that they will do Statement 101 1 year earlier. And then for the January 31st to May 31st fiscal year ends, in general, they are implementing a fiscal year later than the June through December fiscal year ends. And in the case here, you see that Statement 100 will be implemented in 2025 rather than 2024, and Statement 102 in 2026 rather than in 2025. So that brings us to our first poll question. Which topic in today's webinar are you most interested in learning about? A, GASB Statement 102 on risk disclosures. B, Single Audit Update. C, Financial Data Transparency Act. Or D, GASB at 40, what have they done so far and what is coming up for 2024? I'll give you a moment to respond to that question. Remember, there is no right answer to this, but if there were, you wouldn't have to get the right answer. It looks like we're getting pretty close to most of the people who've responded. So I'm going to move on to the next slide and to GASB Statement 102 on certain risk disclosures and hand off the microphone to Matt.
Thanks, Dean. If you guys want to just make sure you finish voting on your poll questions, you'll need to answer a certain percentage of those to be able to get CPE credit. You don't ever have to get the right answer, but you do have to answer. It does look like we had a pretty nice spread across the answers on what everyone's interested in, which is great, because as I'm getting ready to talk about GASB 102, I feel pretty bad if that was 0. So it looks like we have a pretty nice spread across them, with a slight win on for Miss Becky Hammond on the single audit updates coming up. But for now, we'll go right into GASB 102, certain risk disclosures. It feels like just the other day, GASB broke the 100 mark, and we're already now talking about those 3-digit GASBs. So it's very, very exciting news. I am happy to be able to tell you that this standard actually isn't going to be too bad to implement. It's a disclosure standard, so we're not looking at lots of journal entries and actuarial calculations and having to use a whole bunch of specialists here. So it's really just whether we're going to disclose certain things. And let's talk about what it's for. We know that governments are generally subject, just like any other entity in our personal lives, subject to lots of different risks. There's all kinds of uncertainties in our world. And some of those risks we are already required to disclose. So think about when you're doing a disclosure for your investments, we are already disclosing by GASB rules, interest rate risk, credit risk, custodial risks, and things like that. When we have insurance for risks, we have some specific disclosure requirements around this. This GASB is really intending to address some disclosure requirements for risks that maybe haven't been required to be disclosed in the past, and that we don't see, from my experience, both preparing and reviewing financial statements, we're not always seeing some consistency in practice in these disclosures. And I think part of it is to ensure that the information is getting out to our stakeholders. But another part of this disclosure requirement is to get some consistency in practice, because some governments are already doing parts of this GASB, even though it's not required in their notes. So we're moving forward. We're looking at when do we decide what we have to disclose? So this standard is specifically focusing on the risks that exist when a government has certain concentrations or constraints. When you hear those words, concentrations and constraints, a concentration is going to be when we have some limitations, some lack of diversity that happens in our ability to raise money, to pay our debts, to provide the level of services we want to provide as our government. There's some kind of lack of diversity in the underlying things that allow us to do that work, to do those services, to pay our debts. And so a concentration is just almost like the natural environment that we live in. And that could be an example of one on a concentration that could impact our ability to raise revenues or provide services in the future. Could be something like our taxpayers are composed, our top 10 taxpayers, number 1 on that list pays 50% of the ad valorem taxes in our community. Well, that would be, major taxpayer. There's a big manufacturing plant. That's a concentration. There is some risk hanging out there that if that plant were to close, pull out of the area, that our property tax revenues could go down substantially. There's also indirect concentrations. If you think about it, if say I'm from Gainesville, Florida. So most of our employers, our major employers in my town, do not actually pay property taxes. University of Florida is a really big one that they don't pay any property taxes for themselves or most of the hospital they run. And they are a major employer in our town, though. And so if they were to, decide to move to one of our competing towns like maybe Tallahassee and move the Gators up with FSU, if UF pulled out of our community, even though they don't directly pay taxes, all of those employees and students would probably follow them. And so we would have a much lower income coming into our community to spend to generate things like sales tax and property tax. So it doesn't have to be as direct as someone who's directly paying you taxes to be a concentration. And then a concentration on the supplier side would be if you are, operating a government-owned utility, and you are getting all of your some kind of specialty parts that you need to run your generating plant from one supplier, and they're the only supplier who does it. If there is a supply chain issue, and the pandemic is one of the things that actually triggered the standard that triggered GASB to speed it up, is if there's a supply chain issue and suddenly you can't get parts, you could be dramatically impacted in your ability to continue to provide the services you're providing, or you might have to go outside the market and buy much more expensive parts. And so if we just think about that concentration, we don't have there's one entity, one entity's change in our community that works with us, that could have a much huger rippling impact on our ability to provide services, pay our debts, get our revenues. So it's that lack of diversity, one really big thing. A lot of governments actually already disclose this in their notes, but everyone doesn't. So that's one, with concentration. A constraint, however, is when we have some kind of limitation on our ability to, same thing, raise revenues or spend the money we need to provide the services that we want to provide, that is actually imposed either externally by some other governing body, by some third party. Think when we talk about fund balance definition, think restricted fund balance. That would be the externally imposed constraint, or internally by our government's highest level of decision-making authority. Think commitment when we talk about fund balance definition. So the kind of things that create committed or restricted fund balance could impact some of these constraints. And it's the same sort of definition there. So some examples here could be if we have, in the state of Florida, we have a millage rate cap and certain other Florida statute requirements on governments, if they want to adjust their millage rate on their property taxes. There's all kind of different constraints around that that are set by the state. A local government cannot choose to just do something different. Those are that ability to raise money. So if I am a government and I'm already levying 10 mills, then I have a really pretty substantial constraint that if something unusual were to happen, I can't just go raise extra property taxes, right? I'm limited at that. So that's one other example of that. You could have a debt limit imposed on you, or that you have imposed upon yourself at that highest level of authority. You've got an ordinance or a resolution that says we cannot issue debt beyond this limit. Some kind of spending mandates, we're only going to spend in this geographic area, could impact your abilities as well. And so it's really these concentrations and constraints are just lots of different ways that we kind of think what could go wrong in our ability to provide services at our current level of revenues. And that could be any of these things. And so GASB says these things are not always being consistently disclosed. So next slide, let's figure out what do we need to disclose. These are just really definitions and concepts, but our next slide is going to talk about what is our disclosure criteria. So our disclosure criteria is we really need to, as governments or auditors, be aware of what these concentrations and constraints are in our government. So we have to really assess these every year. What are they? like brainstorm, what are my concentrations and constraints? Any of them that I know about before the date that I'm actually issuing my financial statements for the prior year, I need to kind of assess those. What are they? And then are those concentrations and constraints, are they things that would really make us vulnerable to some kind of substantial impact in our ability to pay off our debt or provide our services that we're providing? Is there some kind of risk associated? I may have a big concentration or constraint, but maybe I've got a 10 mil constraint, but I'm only actually issuing my millage, my property tax millage rate right now is only 3 mils, right? Okay, it's a constraint, but it's not a constraint that feels like it could really have a substantial risk to me of the ability to continue my services. And so what are they? And then what's the impact if things go wrong, right? So that's the first 2 bullets. The final thing I have to do, because if I had to disclose all that, that might be kind of annoying. But GASB actually, I think, did a great thing here. And they said, really what we want to do here is kind of think something a little bit parallel to going concern disclosures is in order to have to disclose either any of those concentrations or constraints, they have to meet both the first bullet. They exist. I know about it. It may have a big impact if things go wrong, but we also have to have a triggering event. And so this is where I think we're really going to have fairly limited disclosures of these on an ongoing basis, or at least mandatory disclosures. And so that event has to have happened that could trigger the risk to either the impact has occurred, they moved out, and our property taxes just dropped dramatically, right? So it actually has occurred. Let's disclose that, obviously. It's begun to occur. You know, they've announced they're moving, they've moved out half of their employees, but not all of them. Property taxes this year are fine, but we know they're going to be bad next year because of this, right? So it's kind of starting, or is more likely than not to begin to occur within the next 12 months. And this is where I feel like it's a little bit parallel to our going concern requirements. And so if we've actually, for example, have that instance where we have University of Florida decides to leave Gainesville, and they've announced it, it's formal, they've started buying property in Tallahassee. I know all my Gator fans are yelling at me, but I live here and I'm a Gator, so it's okay. So, you know, we've bought property in Tallahassee, we're moving the stadium, the swamp and everything, right? So if that has occurred, or it's really more than likely to have occurred, that we're going to really get that impact on our revenue sources within the next 12 months of when I issue, not your financial statement date, but the issuance date, then I need to disclose it. I'm going to turn it over to Matt here to kind of talk about what those disclosures look like. What do you actually have to disclose?
Great. Well, thank you, April. So I'm going to cover a little bit of information on the disclosure criteria and principles. There are some things in Statement 102 that provides some additional detail of disclosure criteria. So really, the disclosure criteria should be assessed for the primary government and all other reporting units that report a liability for revenue debt. So in that instance, you might meet the disclosure criteria for an individual enterprise fund, but not necessarily for the primary government. So you need to assess that across other reporting units when you're evaluating the disclosure criteria associated with Statement 102. Also, if mitigating actions are taken by the government prior to the issuance of the financial statements, and that causes any of the disclosure criteria not to be met, then there is no disclosure required. So if, for example, you know, the government has taken some sort of step to mitigate the substantial impact, and therefore there is not going to be a substantial impact to the financial statements, you therefore did not meet the disclosure requirement and no disclosure is required. Also in the statement, there is a provision for a comparative financial statement. So some governments present comparative financial statements where you present a current year and prior year. And the disclosure states that the requirements only apply to the current period. So you would not need to go back and present that for the previous period, because obviously, you know, if you met the criteria, it would be applying to the current year. And then also, the government should provide information in sufficient detail to enable users of the financial statements to understand the nature of the circumstances disclosed, and the government's vulnerability. So keyword there being sufficient detail. You want to provide that disclosure that allows users of the financial statements to really understand the government's vulnerability, what that vulnerability is, and how it creates a substantial impact associated with the concentration or constraint. So once the government has evaluated that they have a concentration or constraint, and they evaluated that they meet all of the disclosure criteria, the next step is going to be to incorporate this into the notes to the financial statements. So the standard says that you have to include a description of the concentration or constraint in the note disclosure and other information in sufficient detail to enable users to understand their nature and also the government's vulnerability to the risks of a substantial impact. So again, keywords there being sufficient detail. You want to elaborate and provide enough detail in the note disclosure so that users would understand, what is the government's vulnerability? How does this impact, or how does this create a substantial impact on the financial statements? So that is, the opportunity for the preparer of the financial statement to kind of elaborate and go into detail regarding the concentration or constraint. Also, if the event or events associated with the concentration or constraint occurred before the financial statements are available to be issued, then you're also required to include a description of each event associated with the concentration or constraint, as well as a description of the actions taken by the government to mitigate the substantial effect. So when I read this basically means if that event has occurred, you have to provide a description of what that event was, and also a description of what management or the government has done to mitigate the substantial effect associated with the concentration or constraint. It is quite possible that these disclosures could overlap with other required disclosures regarding Statement 102. So in those instances, there is a provision in the statement that says the statement can be combined, or the disclosures can be combined as part of other disclosures that include other concentrations or constraints. So this provision is there, to avoid any unnecessary duplication of note disclosures. It also allows, one note disclosure to satisfy two statements. One example I could give on this is subsequent events. You could have, a subsequent event that has occurred since the financial statement date. And if that subsequent event was also associated with a significant concentration or constraint, then you would include, the other required elements of Statement 102 disclosure requirements to allow for that one disclosure to tackle both, your subsequent events and your disclosure requirement associated with Statement 102. So when do we have to start considering implementing this disclosure standard? So GASB Statement 102 is effective for fiscal years beginning after June 15, 2024, and all reporting periods thereafter. That would make it required for June 30th, 2025 fiscal year ends, September 30th, 2025 fiscal year ends, and December 31st, 2025 fiscal year ends. And as always, GASB does encourage earlier application, and as we mentioned before, this disclosure standard doesn't appear to require too much effort. I think we have plenty of time to consider what concentrations and constraints are out there, and whether or not the government is going to be meeting a disclosure criteria to include in the notes to the financial statements. Now I believe we do have a polling question.
We do, Matt. Thank you. Thank you so much, Matt and April. Our second polling question, which I will launch right now, is what types of risks does Statement 102 address? A, credit risk, B, certain concentrations, C, certain constraints, or D, both B and C. April or Matt, we did have a couple of questions. I'll pose the first one to you, and either one of you can jump in. The question was, is there a percentage suggested related to what is a concentration, such as 10% or 20%?
So I don't think there's an actual percentage that you can just use as a set amount. It's really going to be a judgment call of looking at what that risk is, right? So the percentage may be very different in different situations. I could have a concentration that I get all of my lawn mowing equipment for my parks from one vendor, and that, you know, I would have to buy all new lawn mowing equipment if that vendor went out of service, you know, out of business. And so that would be 100% of my lawn mowing equipment, but the risk to the government of that, of a parks maybe not getting mowed for a little while I get that rebuilt is probably not that high. So really, it's going to be professional judgment when you look at this, and you've got to look at it together with the concentration or constraint, and then the associated what could go wrong, what would the impact be if that happened. And so you might have a low risk on your, a low concentration, you know, something way less than that. So maybe 10% of your property taxes come from one taxpayer. But that might be much riskier to your government if property tax is your largest tax source and you can't raise your millage because you're already at the cap, kind of thing. So really, you almost have to look at it holistically, I think, and just use some judgment, recognizing where are my riskier areas where I might need to be looking at a smaller percentage to identify those concentrations, if that makes sense.
It does. Thank you, April. I'll answer the other question that came up. Is a city's charter cap on millage rate to be assessed viewed as a reportable constraint? Does it matter if the city's current millage is already at that charter's millage rate cap? So what GASB Statement 102 requires with respect to constraints is that they be imposed by an external party or by formal action of a government's highest level of decision-making authority. And so if a charter provision meets that requirement as a formal action of the government's highest level of decision-making authority, or if charter provisions are the result of externally imposed limitations, such as by vote of the populace, those might qualify as acceptable constraints or applicable constraints under Statement 102. So moving on, our next topic is an update on single audit, which Becky is going to present, and she's got a lot of ground to cover.
Hello, everyone. Happy to be here today to present the single audit update. It is an abbreviated version, but as Dean said, I have a lot to cover in a short amount of time, so I'll be going pretty fast, but hopefully give you some great information. So first up, I'm just going to do a quick overview of the 2023 compliance supplement. There is a large amount of historic federal funding going on right now in the environment. It's COVID-19 funding still in there, as well as some new Infrastructure Investment and Jobs Act funding. These new programs and the continued impact on the existing programs from receiving additional funding are adding lots of new recipients and an increase in first-time single audits. And in addition, higher risk classifications by the OMB will continue, which impacts the major program determination. And some of these programs are having to be considered higher risk for a second year for this year. In addition, there are a number of COVID-19 waivers that are expiring. So those time waivers or particular requirement waivers are now expiring. So there are more compliance requirements that are being required of you. As a result of all of these things, there's a continued workload compression on the auditors, as well as you folks out there that are actually at the entities trying to pull together the information and maintain the compliance at your entity level. And then in addition to that, there's increasing federal focus on oversight, accountability, and transparency. So the bottom line is there is still a lot of stress to the single audit system, but remember that the focus should remain on quality. A little background on the Infrastructure Investment and Jobs Act, since that is such a large amount of spending. It authorized $1.2 trillion for spending. It was signed into law by President Biden on November 15th of 2021. One of the biggest pieces of the bill was $550 billion designated for new federal transportation infrastructure and broadband programs. And each of these programs results from lots of unique aspects, which has caused quite a challenge when the OMB was trying to put together the compliance supplement. It's probable that significant amounts of this funding will be either passed through states or received directly by both the non-federal entities and for-profit entities. And a number of those funding items are even having to be not just passed through, but having to be applied for. A few important links that I've included in the presentation for you is a link to the compliance supplement. And I know you may be saying, well, I'm not an auditor. Why do I need the compliance supplement? But I always think it's good to know what you're going to be audited on. So if you have these programs and you know that you haven't been audited in the last 2 years, then that program, if it's over $750,000 or over whatever your threshold is, it will probably be coming around. And even if it's not going to be audited, the compliance supplement gives you some really good knowledge on what some good controls and good procedures are going to be. So if you're preparing for what the audit's going to be, you can make sure that you're going to be in compliance. We also have a link here to the Office of Federal Financial Management, which has a lot of good information on the grants management process. One more link, this is sam.gov. This gives you a link to all of the assistance listings, which will help you when you're trying to put together your schedule of expenditures of federal awards, your CFA. There's entity registration available there. And then it also has all of your exclusions. So if you are looking to make sure that your vendors are not suspended or debarred, you would go to sam.gov in order to do that particular part of your compliance requirements. The effective date for the 2023 supplement is for fiscal years beginning after June 30th, which means all year ends June 30, 2023 and after. And there will be no future addenda expected for the 2023 supplement. A few just acronyms and terminology for your reference here. So I will try to say it when I go through it, but just so if you see these acronyms, you'll know exactly what they mean. And we have our first poll question of this section.
Thank you, Becky. Poll question number 3, what does CFA stand for? Is it A, simple equations for animals, B, Soviet-era film actors, C, schedule of expenditures of federal awards, or D, none of the above? And while you're answering this question, I'm just going to move to the next slide and allow Becky to continue her presentation.
So one of the first things that when you're looking at the compliance supplement to look at is Appendix 5. It has a list of all the changes that were made for the year compared to the prior year. You should definitely check Part 4 of that section. But the problem with this year's supplement is that it was not prepared in as much detail. So it basically just tells you a change was made to a particular program, but it didn't say this year what the change was. So you will have to actually compare the 2023 supplement to the 2022 supplement in order to get an appreciation for what might be different in your compliance requirements. Unfortunately, I think they did that in order to be able to get this compliance supplement out sooner, but it makes it a little harder for us to know what they changed. You will need to read the supplement for any applicable major programs carefully for the changes. Again, that's certainly needed if you're an auditor, but I highly suggest it even when you're at the entity level because it really does prepare you for what is going to be audited. A few changes in Part 3, which are the compliance requirements. The first is cash management. the suggested audit procedure for compliance procedure number 7 was clarified. And this is basically for expenditures. Previously, we had to look to see if the expenditure was paid prior to the date of the reimbursement request. Well, they've clarified that to say, no, the expenditure just has to be incurred prior to the date of the reimbursement request. I think this is a great change and something that has resulted in some issues in the past. It makes much more sense to be incurred versus paid. A new procurement requirement resulting from Section 70914 of the Build America, Buy America Act, which was effective May 14th of 2022, unless you have a waiver, is that all iron and steel used in the project have to be produced in the U.S., all manufactured products and all construction materials that are manufactured and included in your project have to be manufactured in the U.S. This was a particular requirement that was a standard requirement. We saw it a lot in the transportation programs with the FTA, but they have now expanded it into a number of the other federal programs as well. And for reporting requirements, performance and special reporting provisions continue to be in the supplement. However, they've clarified that testing is only required for key line items that are quantifiable and capable of evaluation against objective criteria. So what this means is that you will no longer have auditors asking questions about all kinds of reports that really aren't as pivotal to the compliance of your program. If there's no key line items identified, the auditor only needs to test that the performance and special reports were submitted timely. If key line items are included in the supplement that are not quantifiable, the auditors are not required to test those. And auditor documentation supporting this determination should be included in their work papers. So they may be, asking you some questions here just to make sure that they understand the environment of your reporting. And Appendix 7, I just like to highlight this. This has been in the appendix for several years now, but it's still one of those common errors that we see a lot. The presentation of COVID-19 funding on both the CFA and the data collection form. We want to make sure that when you're preparing your CFA and your data collection form, that there's a separate COVID-19 designation for any of the programs that have COVID-19 funding. That should be a prefix to the program name. And then on the data collection form, it will also be same thing in the program name before it, and it should show twice in addition in the additional award information field. And the next slide has an example of that, just so you can see how you can see that twice. They are absolutely looking for that and will reject your submission if this is not accurate. So just make sure that those things are happening. Additionally, in Appendix 7, there's a discussion about the Federal Audit Clearinghouse transition from the census to the General Services Administration, and some extensions resulting from that. So the new host has been up and running now. If you've already submitted, if you have a June 30 year end, you've probably already submitted your single audit and determined that it's a little bit of a different process. And I actually have some slides a little bit later that are going to go through that. So if you haven't seen it before, or if you have, we have a couple little tips for you on that submission of the data collection form. But because of this change, they did provide a waiver of the 30-day filing requirement because there was a period of time where we could not submit the data collection forms. So for 2023 submissions with fiscal periods ending between 1/1 and 9/30, and then 2022 submissions with fiscal years ending 1/1 to 10/31, Those are now due within 9 months after the fiscal period end date instead of 30 days after your financial statements are issued. Next up, just some changes and expected effect on the major program determination. The first big thing, each year they will always look at programs and add some programs. So this is a listing for your reference of all of the programs that they added. They, as a result of the IIJA funding, decoupled the highway planning and construction cluster. Decoupling means instead of treating all 4 of these programs as one when they are considering it for major programs and in the testing, they have now separated them back out. And that was because of those unique funding requirements required by the Act. They thought that the requirements were too different and it made it too difficult for them to be able to have the auditors audit these programs. So these are now separated. In Appendix 4, this is the location of your programs identified as higher risk. So you can see if you've looked at this previously, there are a number of programs on here that have been on here for many years. And most notably, the Education Stabilization Fund, which is funded with COVID-19 funding, and a number of the Treasury funds, which are all COVID-19 funding. And just gives you the new interior IIJA funding was the only one added with IIJA funds. There were 5 programs removed from the higher risk list, and you'll see that here. So if you had that program previously, you'll be happy to know that it is not automatically deemed higher risk anymore. So what do we do with this? Well, some of these programs are brand new for June 30, 23 and later year ends. So if it's a type A, meaning 750,000, or if your CFA is a larger CFA, then that threshold might be higher. Then if it's a higher risk program in the appendix, it's going to be a major program. So you already know it's going to be selected by your auditor, and you can be prepared for that. If it's under 750,000 or whatever your type A threshold is, then it may be a major program, but there is some judgment allowed by your auditor. So the auditor is going to look at things like oversight, submittal of backup, the dollar amount of the program, complexity. If it's new, are there any other high risk indicators that, and that generally will mean that it's a major program. But if it's something that's very similar to a program that you already have and you have the same people running it, then the auditor may be inclined to say that that's not a higher risk program. So there are a lot of factors that go into this, and each auditor will have to make that determination separately. Now, some of these programs were audited at June 30, 2022 through May 31st, 23 year ends. So if that's the case, if it's type B, it's absolutely a judgment call. We're not required to call it high risk because we've already looked at it for 1 year. And as long as there were no findings or issues, we could say that it's a low risk program. For the type A, if it's over the 750,000 or whatever your type A threshold is, per the compliance supplement, an auditor is not precluded from determining that a higher risk ARP type A program or other cluster qualifies as a low risk type A program if both of the following are met. So basically, the program otherwise meets the criteria for low risk, meaning that it was audited within the last 3 years. There were no findings, basically no significant deficiencies or higher, and several other criteria that go along with that. But basically that it was a clean program, and that the percentage of the COVID-19 or IIJA funding in the program is not material to the whole. to the whole of the program, which basically means that it's not more than about 5%. Now that percentage could be different depending on the auditors, but if you're a PPC firm, the threshold is 5% here. So what does this mean? It means if you have any of the programs that were on that higher risk, then if it's over the 750,000 or whatever your type A threshold is, it's going to be a major program. You already know, be prepared for that. If we have one of the existing programs with COVID-19 funding added and the funding portion is 5% of the program, then or more, then it will also be a major program. So just something to keep an eye out for. It's just kind of being able to be prepared and know what you're going to be looking at. The inclusion of COVID-19 funding within the R&D cluster, research and development cluster, does not result in the program automatically being considered high risk. We do have to look at changes to systems, personnel, operations, and types of activities funded that may result in that determination. So know that if you have R&D programs, that's a little bit of a different animal. And then if you do have any Education Stabilization Fund, which is the 84.425, there are a bunch of alphas, which is a result of just a bunch of funding that was set up under those programs. We consider that one program no matter which alphas are included. All right, I believe we have a poll question.
We do. Poll question number 4 is which section of the compliance supplement addresses higher risk programs? A, Appendix 4, B, Appendix 7, C, Appendix 14, or D, none of the above. While you're answering that question, if you didn't catch the sharing of the results to polling question 2, the answer was statement 102 covers risks related to certain concentrations and certain constraints, which was answer D, both B and C. And the answer to poll question 3 was that CFA stands for Schedule of Expenditures of Federal Awards. Becky, there's a quick question here that I think it's kind of beyond the scope of what you're presenting on, but maybe you might have a suggestion as to where they might find the answer. And the question is, can COVID grant money be spent by cities on other activities?
Well, I think you have to look at, since there's so many different COVID programs, you have to look at each particular program and see what are the activities that are allowed for those particular programs, and do the expenditures that you are trying to spend the money on fit in to those activities that are allowed. And the compliance supplement does go through that, as well as your grant agreement should. And then I would also suggest that you could actually go search on the particular agency's website, which will have a wealth of knowledge on what those activities allowed are as well.
Thank you, Becky. I just shared the answers to poll question number 4. The correct answer, if you're interested, was A, Appendix 4. Well, let's move on, and Becky has so much more to cover.
All right, so I'm going to move through this very quickly. Just want to make you all aware that for the coronavirus state and local fiscal recovery funds, that there is an alternative to the single audit, which is an examination. You have to meet the following criteria. You have to have a total allocation under 10 million. That includes both your direct from the Treasury and anything received through the states as a non-entitlement unit. Your other federal award funds have to be less than 750,000. And essentially this allows the governments that exceed the 750,000 only because of the spending of the coronavirus state and local fiscal recovery funds to avoid the expense and complexities of a full single audit. There are some preconditions for the examination. Management must be able to provide documentation that it meets the eligibility requirements. They must accept responsibility for the compliance with requirements described in the compliance supplement, and they must evaluate the entity's compliance with the compliance requirements. And these are assertions that management will give to their auditor. The professional standards under the examination are going to be government auditing standards as well as compliance attestation standards. And there is a practice aid out there that the GAQC has issued, which will help your auditor and actually help you prepare for your audit. This is open to the public. So all you will need, though, is an AICPA account, which anyone can establish. And then the submission requirements for these examinations are a little different. The instructions for submission are on the FAC Treasury portal. This is not the new FAC website. Some folks get a little confused here. This is a separate portal. And this deadline does mirror the single audit submissions, which is the earlier 9 months after fiscal year end or 30 days after the report release. If you have provider relief funds, there's also an alternative to the single audit for these funds, which is the audit of costs and lost revenues. I've given you some requirements information here for your reference. This audit is a Government Auditing Standards Yellow Book engagement. It's an audit over the statement of costs and lost revenues. It requires the same documentation as a financial statement audit would that's performed under Yellow Book, and there's no opinion on the compliance issued. There are some reporting templates out there on the Government Audit Quality Center, and the reports have to be submitted directly to the DHS at that particular link. And these are due 9 months after year end. All right, moving on to the new GSA Federal Audit Clearinghouse. I know a lot of you are interested in seeing this. So the new provider has changed. I've given you a link to the new website. Any draft that is not fully submitted to the census FAC now has to be completely restarted. So if you started your submission but didn't finish it previously, you now have to redo it under the new GSA Federal Audit Clearinghouse system. So just some slides that show you what it looks like when you go in. This is the sign-in screen. Then you're going to have to log in and authenticate with login.gov. Once you actually get in, you will see a single audit submission screen. So you'll agree to the terms and then start a new submission. First up will be your submission eligibility questions. This is all the standard information about your entity and whether you spend $750,000 or more in federal awards. Some more information. Then you'll put in your unique entity identifier number, your period information. Then you're going to put in your auditee and auditor contact information. And then we're going to pause real quick for a polling question.
We're on to polling question 5. Which federal agency is the new host of the Federal Audit Clearinghouse? Is it A, the Bureau of the Census, B, the Department of Commerce, C, the General Services Administration, or D, none of the above? And while people are continuing to answer the question, I'm going to turn it back to you, Becky.
Thank you, Dean. So after you've put in all of the entity information, you're then going to see this submission checklist. And each time that you complete an area, it will turn from the blue, as you can see here, to purple, so that you know that you've put in information and completed that particular section. So first up is the general information form. This is just your period information and what type of uniform guidance audit you're filing. And then you'll present your information on what type of opinion, was there a going concern, any deficiencies, material weaknesses, or non-compliance. Also, if you are presenting a report that includes any departments or agencies, what your type A threshold was, and whether you qualified as a low-risk auditee. And then lastly, on this section, you will put whether you have any prior audit findings on your summary schedule of prior audit findings for any direct funding. So this mirrors what was the information that was put in previously under the Census Bureau filing. Then next up, you're going to upload your audit report in a PDF format and indicate which page numbers all of the specific items that are required are on. So you'll see that here and on the next slide. And then you're going to choose your file and upload it. Then you can see in this part of the submission checklist, if you've uploaded it, it will turn blue. If it's not required, actually, I'm sorry, it starts blue. It will, once you upload it, it will become purple. If you indicate that there are no findings, then as you can see, like upload workbook 3 will just stay black. If you actually indicated there was a finding, then that will turn blue and be able to be clicked on so that you can go and present the information on the findings and the findings text associated with it. Same thing with the corrective action plan. And then again, previously, if you indicated that you had any additional UEIs or secondary auditors, those will be available to you to put in that information. Then you'll have to do a pre-submission validation. And then the auditor certification will have to happen and the auditee certification. Can you go back for me a little bit? As part of this process, you, as the auditee, no longer receive an automatic email when this is available for you to certify. So if your auditor is preparing your data collection form, they are going to have to reach out to you and let you know. If you're preparing the data collection form, then you need to reach out to your auditor and let them know that you've completed the pre-submission validation and the certification, and it's ready for their certification. And then after all of that is done, the auditee only, the entity, has to come back in and submit to the FAC for processing. The auditor is not allowed to do this for you any longer. So a good way to figure that out, and you'll see here, you'll press that button and then submit the single audit package. You as the auditee have to do this yourself. And then on your screen, you will see, so this is an example of one that's in progress. It hasn't been submitted, and then one that's been accepted. So a good double check is to go back in to the system and see, is your audit in the completed audit section? It may say submitted if it hasn't been accepted yet, but usually it turns to accepted very quickly. So you'll be able to double check that for yourself, just to be sure. All right, and then my last piece is uniform guidance proposed revisions. There's a number of revisions that were proposed on October 5th, 2023. We are anticipating any time now that they will be coming out with the final version of this, and these will be implemented. However, they still may be subject to change after the comment period was completed, but most notable, an increase of the audit threshold from 750,000 to $1 million, but they're not looking to change the type A threshold. So they'd still, if you have $1 million of federal funds, then you'd require a single audit, and 750,000 would remain as your type A threshold. They're proposing an increase in the de minimis indirect cost rate from 10% to 15%. An increase in the threshold for capital expenditure from 5 to 10,000, an increase of the amount of the sub-award cost that can be counted within the modified total direct cost base from 25,000 to 50,000, and removal of the simplified acquisition threshold cap of 250,000 for fixed amount sub-awards. In addition, they are requiring the schedule of expenditures of federal awards to identify the recipient of a federal award in audits that cover multiple recipients. use of the term recipient or subrecipient in lieu of non-federal entity throughout all of the subparts. So the little change in terminology there. They're looking to remove items currently included in the listing of prior written approval requirements. And I've listed those here. And also remove the existing requirements in paragraph H of section 200.414 for all indirect cost rates to be made publicly available on a government-wide website. So just lots of little changes. And this is just the highlight. There are some other smaller changes as well. The comment deadline was in December of 2023. The final changes are, as I said, expected to be published any day. And if you'd like to see a copy of the proposed rules, they are right here in this link for you. And my final polling question.
Thank you, Becky. What changes has OMB proposed for the uniform guidance? A, increase audit threshold from 750,000 to 1 million, replace non-federal entity with recipient or subrecipient. C, increase the de minimis indirect cost rate from 10% to 15%, or D, all of the above. While you are answering that question, I will mention that the answer to polling question 5 was that the new host of the Federal Audit Clearinghouse is the General Services Administration, or GSA. I'm going to move forward to the next section on the Financial Data Transparency Act while the last of you are answering that polling question, and turn things over to Pat.
Thanks, Dean. So what is this Federal Data Transparency Act? So this was included in the National Defense Authorization Act in December 2022, making it law. And the purpose behind it is to modernize the collection and dissemination of financial data by federal financial regulators. It's going to make the data more uniform and useful for investors and consumers. It's going to require U.S. Treasury, SEC, MSRB, and 5 other federal regulators to establish data standards for this new law. So although the FDTA requirements related to the collection of this information by all 8 of these federal regulators, most of the discussion around this has been about continuing disclosure requirements of the SEC, specifically in SEC Rule 15C2-12 for the submission of information related to issuers of municipal debt to EMMA. EMMA is the Electronic Municipal Market Access, the repository by municipal service rulemaking. If we could go on to the next slide, Dean. So what does this FDTA require? One thing to note is the FDTA is explicit in stating that it does not require any new disclosures, only a change in the way the disclosures are made. Basically, the FDTA is aiming for a system comparable to what's used in publicly traded companies when they submit their financial statements to Edgar. Some of you might be familiar with that. For the compliance with SEC rules. So that's basically what's going to happen here, except it's going to be for governments. The data standards are going to be in open data format, in which the information is going to be available for download, readable format, accessible digitally and bulk by platforms that collect and analyze data. One of the interesting facts with this is that currently, over 95% of visitors to that Edgar site are machines. And ultimately, the same is likely going to be true with EMMA and other databases that are going to use this data standards under this FDTA. So some of the data standards should include, they're going to establish common identifiers for transactions and financial products, including non-proprietary legal entity identifiers. So it's going to help identify the governments in the same manner. No, regardless of which regulator is looking at them, they're going to be able to be more uniform in their identification. It's going to make the data fully searchable and machine readable. It's going to create this taxonomy that defines the data points and are required to be submitted, be non-proprietary, be consistent with standards of the regulators, and be based on applicable accounting and reporting principles. A key point there with that last bullet is that the data standards will need to be allowed, will need to allow for reporting that's not only GAAP, but also non-GAAP. So it could be a cash basis or a statutory basis. So all governments are going to be able to use it. And then if we go ahead and look at this timeline here, one of the things to note is the SEC is required within 180 days and every 180 days thereafter for the next 7 years to publish a report on the experience of the machine readable data for corporate disclosures, including a cost benefit analysis. So far, the first 2 reports have been issued. What is unclear at the present is regarding the timeline is when the SEC will select an organization to actually create the data standards in relation to the rules and when the data standards will be available. So at this point, we just don't know who the SEC is going to select for that. And if you wanted to go ahead and take over the potential benefits, Dean.
Absolutely. Thank you, Patrick. One other thing that's worth mentioning related to the deadlines is, sometime during the course of this year, the SEC is supposed to propose this rule related to the data standards and finalize it by the end of this year. And then the agencies, the SEC and the other federal agencies that are affected by this are required to comply with it within 2 years after that. So by the end of December 2026. But there's one exception to that, and it happens to be the exception happens to relate to the thing that, as Patrick mentioned, most people are focusing on, which is submissions to EMA. And it's not clear based upon the provisions of the FDTA when that will take effect, when governments that are required to submit information to EMA will have to use the new data standards. So that's up in the air as well. But I think we at least know that it's likely to be longer than the 2 years that are being provided to all of the other agencies. There are, I think, some clear potential benefits here to a variety of parties from FDTA, at least as it's envisioned. The most significant of which is that people who need to obtain and analyze governmental financial data should be able to do so a lot easier and for far less cost. For any of you who have ever done research with governmental financial statements, you know that they all have to be hand collected, and then they're not machine readable for the most part. You have to manually extract the information and type it into a spreadsheet, and it requires some more sophisticated software in order to make that process less laborious and less manual. But those types of systems aren't available to everyone, so it's generally very hard to do research or analysis in this area without either spending a lot of time collecting the information or paying some company to do it for you. And so that could level the playing field significantly for investors, particularly individual investors and smaller investment firms that might not have the resources, the capacity to do that kind of analysis and that type of data collection. And this will be true as well for academics and researchers and think tanks, citizen and taxpayer organizations that collect information and make comparisons across governments. The data reporting requirements, according to the FDTA, are allowed to be scaled in order to reduce the burden on smaller entities and minimize disruptive changes to affected entities. It's not clear whether there will be anything like that, whether that's necessary, and if the SEC decides it is, what form that would take. On the flip side, the initial cost of creating the data standards and the ongoing cost of maintaining those standards going forward, it's not clear who's going to pay for that. As Patrick said, the SEC hasn't identified who's going to create this taxonomy or these data standards and maintain them in the future. the GASB seems like a natural choice, and they are taking steps to be prepared should the SEC select them to do this, but they don't have, the GASB doesn't have that a budget for doing that right now, and so it's not clear who's going to pay the GASB or some other entity to do this work. And of course, there's going to be a cost to governments to adopt the data standards and comply in the future, and there's a lot of concern with smaller governments that still have to submit information to these federal agencies or to EMA because they've got outstanding municipal debt, and as to whether they will be able to adopt these data standards and use them to report information. Some other major concerns that haven't been resolved yet, and this ties in with what I just said, that governments are already having difficulty with the cost of producing GAAP-based financial statements, and with the difficulty in finding experienced and knowledgeable staff who can do that. And so it's possible that these requirements under the FDTA could make that even worse, and possibly drive some governments away from using generally accepted accounting principles as the basis for their financial reporting to something that's less informative and less valuable to the users of financial statements, like a cash basis. It also might lead some governments to borrow via direct bank loan or some other form of borrowing for which reporting to EMA is not required, so that it would be less costly or less difficult for them to report. But on the flip side, those types of borrowing tend to be more costly than borrowing in the municipal bond market, and is certainly less transparent to the public than issuing debt in municipal markets, because they don't have the same types of reporting requirements that you would if a government issued bonds or notes in the public markets and had to then do the continuing disclosure to EMA. As I've already mentioned, it's not clear who's going to be selected to create the data standards. And I'm personally, this is me speaking, not CRI, I would be concerned if they picked anybody but GASB, since GASB is the promulgator of generally accepted accounting principles and is in a unique position to take on that role, and has the benefit of having a sister organization, the Financial Accounting Standards Board, that does this for the SEC on the private sector publicly traded companies side. It's not clear when the standards are going to be ready for governments and how much time they're going to have to learn them and implement them, but the fact that EMA submissions are carved out and could have a longer implementation period is promising, and that's only exacerbated by the fact that there's only 2 years between when the final rule is published, even if the data standards are ready at that time, and the date when the federal agencies other than the MSRB and EMA are required to start using those data standards for data submission. So that brings us to our 7th polling question. What features does the FDTA require that the data standards have? A, that they be machine readable. B, non-proprietary or open source. C, fully searchable. Or D, all of the above. And by the way, the answer to poll question 6 about the proposed changes to uniform guidance was all of the above. So while you are answering this question, we will transition to the final topic of the day that addresses what the GASB has planned for 2024, which is its 40th anniversary, and so essentially what it has done up to this point, and what it is expecting to do in terms of issuing statements or proposed standards for public comment during 2024. So GASB was created, the agreement that created the GASB was signed in January of 1984, and they had their first meeting in June of 1984. And it was not long after that that they issued their very first statement, which acknowledged the authoritative status of the existing standards from the NCGA and in the AICPA's audit literature. And then it took another 13 years before they got to Statement 25, which was on reporting by pension plans. And then the pace picked up, and it only took another 8 years before GASB issued 25 more statements, and had gotten up to, sorry, I think I misstated that. So it took 10 years to get to the first 25 statements and 13 years to get to Statement 50, probably in part because so much effort was focused on getting GASB Statement 34 out in 1999. Pretty much everything else that GASB was working on was put on a back burner until Statement 34 came out. And then that's when the pace started to pick up, and it was only 2015 by the time GASB had issued Statement 75, and only another 7 years before they reached Statement 100. They issued Statement 100 and Statement 101 in June of 2022. And then, as we heard earlier, Statement 102 was approved in December of 2023. So right now, the GASB's, the sum total of the pronouncements they've issued are 102 statements, 6 interpretations, 15 technical bulletins, 27 implementation guides, and 7 concept statements, which is an impressive amount of work, considering they're a relatively small organization, even over a 40-year period. They also, on an annual basis, codify all of the currently effective guidance by topic in the GASB's codification. That's something they actually update twice a year online in the Governmental Accounting Research System. And each year they issue a new update to the Comprehensive Implementation Guide that includes all of the applicable questions and answers that are Category B GAAP that are currently applicable and effective for governments, and they update that for new guidance that's added each year. Now, all of that sounds like an awful lot for any government to deal with, but in fact, many of those pronouncements have been superseded by new pronouncements. So there are only 78 statements that are still in effect. 24 of them have been completely superseded. And a bunch of those 78 have been superseded in part. There are only 12 implementation guides that are still effective. The other 15 have been completely superseded. One of the 6 interpretations was superseded, and of the technical bulletins, 9 of the 15 that have been issued have been fully superseded. And then even within those 78 remaining statements, it's something of a, if you'll pardon the pun, an overstatement of what any government is expected to apply. Because among those 78, 6 of them are what I would call administrative in nature, that don't require governments to do anything at all. For instance, Statement 95, which postponed the effective dates of statements during the pandemic, or Statement 98 that changed the name of the financial report to the Annual Comprehensive Financial Report. 6 of those 78, another 6, are omnibus statements, which primarily solve problems which should reduce the burden or reduce confusion or uncertainty among governments. Statements 64 and 93 were written in order to cut governments that have hedging derivative instruments a break so that they can continue to maintain hedge accounting. And there are a lot of other statements, as you know, that are limited in terms of the governments that they're applicable to. In recent years, Statement 90 on majority equity interests, or Statement 81 on split interest agreements, which is almost exclusively relevant to colleges and universities, or Statement 80 on blending requirements, which is almost exclusively relevant to hospitals. So when we looked at those slides at the beginning of the webinar today that showed what's coming up over the next few years for implementation, we saw that the pace of implementation has slowed, and I think we can expect that to continue based upon the changes that GASB has made to their current technical agenda. You can see that there are a lot fewer projects on their agenda now than there were just a year and a half ago, or less than almost 2 years ago now. They're working on a lot fewer projects, so that means there's a lot fewer pronouncements that are likely to come out over the next few years. And they've been working on them more deliberately and taking more time than originally expected, particularly revenue and expense recognition, the financial reporting model, the risks and uncertainties disclosure that came out of Statement 102. That was originally supposed to come out 2 years earlier than that. So all of that means that not only are there fewer things over the next couple of years, but if you look, 5 years or so out, that pace that goes down to 1 or maybe 2 implementation requirements each year is likely to continue for the foreseeable future. In terms of what GASB has planned for 2024, they're looking at 2 final statements and 3 proposed documents for public comment. The first of those relates to the financial reporting model, and I'll take this one on, and then the other presenters will deal with the other 4. GASB is expected to consider issuing a final statement in this project next month. This is a project that's taken more than 10 years. It's involved 3 separate issuances of proposals for public comment, a tremendous amount of public input, and a lot of deliberation on the part of the board. If it becomes a final statement next month, they are tentatively talking about an effective date that would be June 30th, 2026 fiscal year ends and later, and it would all be required to be applied retroactively. If you haven't heard, the most significant thing that has happened in this project that greatly reduces the amount of work it's going to require is that the GASB decided to drop everything related to governmental fund financial statements. So the proposed new measurement focus and basis of accounting and changes to the geography of the balance sheet and the statement of revenues, expenditures, and changes in fund balances have all been removed from this project. So what is left, although still significant, is far less burdensome and going to require far less work to implement than what it did when it included the governmental funds. In terms of what's left, there are changes to the provisions related to management's discussion and analysis that are intended to improve its readability and usefulness and to resolve certain problems in practice. Extraordinary items and special items will be combined into a single category called items that are unusual in nature or infrequent in occurrence, which will solve a lot of practice issues. They are going to provide greater clarity regarding what constitutes operating and non-operating revenues and expenses. In the enterprise fund statement of revenues, expenses, and changes in net position, there'll be a new section for non-capital subsidies, followed by a new measurement, performance measure called operating income or loss and non-capital subsidies. And that performance measure will be more directly comparable to what you see as net operating income in the not-for-profit and for-profit hospitals and colleges and universities and other entities that have public counterparts. All budgetary comparisons will be required supplementary information rather than allowing them to be basic financial statements as an option. And as a result, the variance columns for the original to final budget and the final budget to actual will be required. Also, the discussion of budgetary issues will be moved from MD&A to appear with those budgetary comparisons in RSI. And then lastly, major component units will be presented either individually in the government-wide financial statements or in basic financial statements following the fund financial statements. The option to disclose condensed financials in notes to financial statements will be eliminated. There's obviously a lot more detail to go with all of those items, but the good news is that CRI's next governmental webinar in May or June of this year is going to cover those requirements in much greater detail of what is likely to become Statement 103. Matt, will you cover the other final statement expected in 2024?
Yes, thank you, Dean. So I'm going to go ahead and cover the other final statement that's going to go into effect in 2024. This has to do with classification and disclosure of capital assets, specifically capital assets held for sale, lease assets, and other intangible assets. So The GASB is considering issuing a final statement in July 2024, so this would be, over the summertime. The exposure draft was issued in September of 2023, and there was a comment period. That comment period did end in January 5th, 2024. So that comment period has already expired. However, the exposure draft can still be found through the GASB website. Effective date for this new statement is tentatively scheduled for fiscal years beginning after June 15th, 2025, and all reporting periods thereafter. So if you had a June 30th year end, you'll be looking at June 30, 2026, as well as September 30, 2026, and those reporting periods thereafter. The disclosure of capital assets. So this statement is going to require separate disclosure by major class of capital assets held for sale, lease assets, and intangible assets other than lease and subscription assets. So if you have a capital asset that's held for sale, lease asset, or intangible asset, you would be required to separately disclose those by major class. Subscription assets or SPIDA assets would be disclosed separately, but not major class. So, governments in their note disclosures, they already disclose, what their SPIDA assets are, but those still would not be required to be disclosed by major class. You would continue to disclose those separately, but just as a SPIDA asset. So what is a capital asset classified as held for sale? So the capital asset classified as held for sale is if one, the government has decided to sell it, and two, it is probable that the sale will be finalized within a year of the financial statement date. So that would, 12 months from your year-end date would be the consideration given to whether or not you have a capital asset classified as held for sale. So this statement is not likely to require, much work for governments to implement. And really an important thing to note is, the GASB started this project to address inconsistency in the standards regarding non-financial assets, which was highlighted as the intangible lease and subscription assets took place, and they begin to appear in the financial statement. So that is the last statement for 2024, and I believe we are going into the next.
Yes, thank you, Matt. And GASB, in addition to expecting to issue these two final statements this year, also are expecting to issue 3 due process documents for public comment. And the first of these we'll ask Becky to address, which is a project on infrastructure assets.
Thanks, Dean. So this first project on infrastructure assets, the GASB is looking to issue for preliminary views in September, and the comment period is expected to be open until December. Furthermore, once they get past those redeliberations, just to give you an idea, we are looking at an exposure draft currently scheduled for February of 2026 with a comment period until April of 2026, and then a proposed final statement in February of 2027. So this one's still a little while out, but definitely something that we want to keep on the radar, and we'll continue to be providing you with information on it. Currently, some tentative decisions related to this project. It would retain the historical cost and depreciation approach to reporting infrastructure assets with an option to use a preservation method, which is the modified approach. Regarding the modified approach, it would clarify that a change in a government's preservation policy is a change in accounting principle, and the modified approach cannot be used if the condition level of the assets is below the level set by the government. Governments would periodically review the estimated useful lives and salvage values used for depreciation. So that's a little different in that currently you have to set the useful lives, and there's not really a requirement to have to review that other than for purposes of impairment. So that will be something a little different if that winds up being in the final standard. And then another decision is that a component of an infrastructure asset with a significant cost in relation to the total cost of the asset should be depreciated separately if their useful lives are different. So this may require some different types of things to happen in order to determine what is that amount that needs to be separated out. Could make us have to get some cost segregation studies or provide some other ways of determining how to be able to break out those assets if that significant cost of that component is significant.
Thank you, Becky. Following up on what you said here, that the second bullet regarding the modified approach not being allowed to be used if the assets fall below the level set by the government, that's something that came up in GASB's research as an issue in practice. It wasn't clear, whether governments automatically had to stop using the modified approach if the assets, their physical condition had fallen below whatever they established as the expected condition level. And recently, in the GASB's last meeting, which was about 2 weeks ago, they started to talk about the RSI and note disclosure requirements for governments that use the modified approach. And largely, I think, are looking at keeping those as they are, but they are going to consider whether the RSI disclosures related to expected and actual maintenance and preservation spending should be done for 10 years, which would be consistent with other RSI schedules, or just at the 5 that were required by Statement 34. And they're also thinking about whether governments that use the traditional historical cost depreciation method should present RSI that shows their maintenance, their expected maintenance and actual maintenance expenses for either a 5 or 10-year period. But thank you again, Becky. The next project that is expected to have a proposal this year is the Going Concern Uncertainties and Severe Financial Stress project, and Pat is going to talk about that.
Thanks, Dean. So the GASB is considering issuing their preliminary views in December on this. They've spent, according to the GASB, they've spent over 6 years on research before even starting this project. The subject was originally brought to the GASB by the ASCPA, which was concerned. They had a twofold concern. So the existing standards don't apply well to governments. I mean, you rarely see a government cease to exist. That's more common with like a business enterprise. And then two, that users would be better served with disclosures related to extreme financial difficulties well before there's a going concern it ever becomes an issue. So what some of their tentative decisions were that the going concern is substantial. There's substantial doubt about whether the government will continue to exist as a legal entity 12 months from the date of the financial statements being available and issued, regardless of its financial condition. That the severe financial stress would focus on financial stress regardless of whether there is uncertainty about its continued existence. And then 4 categories of relevant factors currently used for the going concern are part of Statement 56, paragraph 17. And some of those are negative trends, such as the government might have recurring periods in which expenses or expenditures significantly exceed revenues. You have recurring unsubsidized operating losses in your business type activities, consistent working capital deficiencies, continuing negative operating cash flows from your business type activities, or adverse key financial ratios. Another category, other identifications of possible financial difficulties are going to be like if they're defaulting on bonds or loans or similar agreements, the proximity of debt and tax limitations, maybe denial of their usual trade credit from suppliers, restructuring of debt, restructuring other than the refundings that typically occur within governments, any non-compliance with statutory capital or reserve requirements. That's always a factor, you know, that governments want to have a certain level of reserves, maybe in their fund balance, or a need to seek new sources or methods of financing, or they're disposing of substantial assets to keep the government funded. Some internal matters besides the financial stuff, there might be work stoppages or other labor difficulties that are going to come into play here, where this could significantly affect the governments. Let's see what else. Legal proceedings, maybe legislative or similar matters that might jeopardize the intergovernmental revenues and fiscal. Let's see, loss of critical license or a patent for a business type activity might be a factor, or loss of a principal customer, such as taxpayer suppliers, or of course, what we see in Florida, a lot of catastrophic incidents like hurricanes, earthquakes, floods, maybe. This could all significantly affect the government and put them in potential severe financial stress or into that going concern category. So these are all the things the GASB is currently looking at related to this.
Thank you, Pat. It's worth pointing out that these two projects, infrastructure assets and going concern severe financial stress, are looking at issuing what GASB calls a preliminary views. So it will look like, in part, it will look like proposed standards, but not what you would see in an exposure draft of a proposed statement. So this is one step prior to GASB issuing a proposed statement. So they will take what they hear from governments and auditors and users of financial statements and other stakeholders in response to these preliminary views, redeliberate all of their decisions, and then at that point they'll issue a proposed exposure draft of a proposed statement. And as Becky pointed out, with the infrastructure assets and looking at that time period, it will be several more years before we get to a final statement in either that project or this one, going concern uncertainties and severe financial stress. The one other project where GASB expects to issue a due process document, and that will be an exposure draft of a proposed statement, is in subsequent events, and April is going to cover that project for us.
Great, thanks, Dean. Before I jump into this slide, I do think it's really interesting to think about the process GASB does to get these standards out. And when we were talking earlier about the new financial reporting model, which it's so grateful that it got scaled back dramatically from the original proposal. It's crazy to me to think that the original invitation to comment was in 2016. I mean, that just it's really interesting to me that it's, you know, this long process. And as everybody on this call, I would hope everyone on this webinar, unless there's a few tax people just trying to get some A&A, everybody on this webinar probably has a lot of direct impacts to them from these decisions that are made by the GASB. And I know, you know, I'm an auditor today, but I spent, you know, at least half my career in industry and working in the finance departments of various local governments. And it just felt like I'd hear about a GASB coming down, like what we're doing right now. Yeah, this is going to happen way in the future. There's just talking about it. And, you know, my putting out fires and just kind of keeping my head above water mindset as a finance director or accounting manager in the local government. It wasn't happening this year. I didn't have to worry about it. Just put it out there. I'll deal with it when it comes. But, you know, seeing sometimes how these decisions are made, I think it really emphasizes how important it is to have your voice heard early in the process. I know when the OPEB standard came out and we learned about implicit rate subsidies, I had a royal fit. I think someone at the GASB probably still won't talk to me about it because the implicit rate subsidy seemed so ridiculous to me at the time when I was having to look to implement it. But I didn't ever send a comment. I never attended any meetings. I never wrote a letter, right? It was all kind of dealing with it once it happened. And so I think it's really what I want to point out is that anybody on this call, on this webinar, as we move forward and GASB starts doing these things, knowing what's way down the pipeline is when you can really make an impact. And I think that happened on the financial reporting model. I think that they actually listened to the users and preparers and everyone impacted. I guess we call them stakeholders now. Listen to everybody and they shifted gears, which I think is amazing. You know, I can be one of the biggest complainers about GASB and some of the things they do. But I think that shows a really good trend and a trend in the governmental accounting and auditing community that we are making our voices heard more. So I think it bodes well for the future. If you're ever bored or, you know, just need something to do on your time off, sitting in a commission meeting, waiting for your turn to speak, reading the comment letters that were submitted to GASB on the financial reporting model improvements exposure draft is pretty interesting and kind of can open your eyes to things that your colleagues are saying out there. So I think they got 279 letters and they're all published on their website. Just in the under each of the current projects, you'll see a little sidebar that says comment letters. And I know I certainly have enjoyed taking a look at those. So anyways, that's my sidebar. I'm going to actually teach you that our last subject today is subsequent events. They're looking at an exposure draft to be issued this December, but it's still a really young project. It's still very early in its infancy. And I don't think it's going to be terribly impactful or difficult to implement either. So subsequent events in general, what are they? They are events or transactions that occur after the financial statement date, but prior to when we're issuing the financial statements, the actual issuance date. So that could be 3 months, 6 month, 9 month period that we need to be evaluating both as preparers and auditors of your financial statements. Are there things that we either need to adjust the numbers for, which would be a recognized event, or disclose that they happen but not adjust the numbers? And that's a non-recognized event. We do have a current standard out there that gives a lot of guidance, GASB Statement 56, and it really defines some of those things, recognized events versus non-recognized events. And again, we have to actually record, if it's a recognized event, it's something that we actually have to adjust our financial statements for, because it's new information we have about a condition that actually existed at the financial statement date. Where a non-recognized event in many cases is new information that we have, something happened after the financial statement date that really that condition didn't exist on the financial statement date. It's something totally new. It's not just better information, but something else happened. So the best example I saw out there was actually in 56, and it was saying if you're a big utility, a governmental utility, and you've got major AR, a very large receivable balance from an existing client, if on you've got your AR, you think it's collectible, everything's great, then a month after you've issued, after the financial statement date is, but before you've issued, right? So September 30 is your year end. Halloween, that big major customer of the utility with a large AR balance, very substantial, goes out of business, declares bankruptcy. That might be a recognized event. In their example, it is, because you don't just suddenly need to declare bankruptcy for no reason a month later, right? At the actual financial statement date, the date you closed your fiscal year, they were probably still already in trouble. So it's better information about a condition that existed at that date. And you would need to go in and revalue that receivable. However, same exact example, but on Halloween, that company, their entire manufacturing plant burns to the ground. They don't have insurance. They close their business too. Well, that condition of not being able to manufacture and continue going on did not exist on the date of your fiscal year end. It actually happened afterwards, and that would be more of a non-recognized event where we would be disclosing. So it seems like we've got a pretty good guidance out there. Why do we need to revisit this? Well, GASB said we've seen some confusion about how to do it. It's out there, but there's so much different occurrences that can have, and the current guidance isn't specific enough. Inconsistency across how people are implementing it, right? That inconsistency in practice, kind of like the first thing I kind of talked about with the risk disclosure for concentrations, right? That inconsistency. They want to make us consistent across the board. And then how useful is that information? So at the end of the day, the main reason they came back is because they saw a bunch of governments disclosing things as subsequent events that don't meet the requirements and not disclosing the things that do. So they're just saying that it's clearly the guidance is not direct enough or robust enough to get that consistency in practice. There's just a lot of judgments that are happening that perhaps aren't meeting what GASB would like to see. So again, we don't have an exposure draft yet, but the tentative decisions they've made so far, they're going throughout all of GASB's going forward that need this language and changing financial statement issuance date to this very specific date the financial statements are available to be issued language. And that's trying to get a little more parallel with some FASB definitions. I don't know that it's substantially different, but you will see that language coming across more. They've decided to retain some of those examples of the recognized events that are currently in GASB 56, like I just gave you one. They want to retain those examples. So recognized events feels like the definition will stay very, kind of similar if the examples might be the same. They are saying that we do need to disclose. They're being very specific about what has to be disclosed. If you have a non-recognized event that's substantial, and fell within the subsequent event period, we want to disclose a description of that event and an estimate of what the impact would be, or why we can't make an estimate, right? And then they also decided that the future statement should add some more examples of non-recognized events to assist in clarity. So at their most recent meeting, they kind of discussed further what those non-recognized events would be. And they have some tentative agreements that if it's significant and during the subsequent events timeframe, in addition to the general description, debt-related transactions would fall under that, which we already do under 56. If a debt is issued or refunded during our subsequent event period and it's significant, we disclose it. Government combinations or disposals of government operations. That's a little broader than the prior guidance that it would be a creation of a new component unit, but you can see the same thought process there. Legal entity changes, really similar to that as well. They did have changes in tax rates, which I think would be interesting because depending on your government, your millage or any other tax rates could have substantial impacts with a change in that, a major increase or decrease in your tax rate. So anyways, keep an eye on this. It doesn't feel like it's going to be really excessively burdensome, but there's definitely the language that you'll need to, change and all of that as we go forward. But again, still on the horizon. Probably don't need too many comment letters for this one, but stay tuned. Stay on top of what they've got out on the horizon, because those are the things that'll blindside you in some cases when they suddenly appear on your doorstep. So I think with that, we have our final poll question.
We do, April. Thank you so much. One last poll question, which I will launch for everyone. Which of the following GASB projects are expected to issue a final statement in 2024? Infrastructure assets, classification and disclosure of capital assets, subsequent events, or all of the above? While you're answering that, we do have one question that came in related to the FDTA. Does that apply only to financial statements or also to continuing disclosures and or official statements? That's a really good question. And obviously, based on the way I'm saying it, not one to which an answer yet exists. It will depend upon what comes through in the SEC's proposed rule. But if I were a betting man, the submissions to EMA are more than just the annual financial statements. They do include official statements. They include subsequent event disclosures, and so if all of that information is meant to be readable, human readable and machine readable, and meet all those other requirements of the data standards, chances are that all of those submissions will be required to use the new data standards. But at this point, that has yet to be determined. So ending this last poll question here and sharing the results, the answer is B, classification and disclosure of capital assets is expected to have a final statement in 2024. Infrastructure assets is going to have a preliminary views, and subsequent events is going to have an exposure draft. So that brings us to the end of our presentation today. I hope you will join me in thanking our terrific presenters. Be sure to follow them and CRI on the various social media platforms. I think we're pretty much on everything except TikTok. Also visit our website, cricpa.com. If you click on Government and Public Sector in the Industries menu, you'll find tons of educational materials and resources on that page, including our ebook, Demystifying Deferrals. Also wanted to bring to your attention that CRI's annual Southern Grants Forum will be held this year in Fort Worth, Texas on July 22nd to 25th. And you can get more information and or register by visiting southerngrantsforum.com or scanning this QR code on the screen, or when you get the or in the PDF of the slides. You can use either one to get more information about that. I participated in that for the first time last year, and it was absolutely terrific. I highly recommend it to you. With that, we're done. I want to thank you so much on behalf of CRI and the other presenters for joining us today, and hope that we will see you soon.